Due diligence rules kick in when a paid preparer touches certain high-error refund items. The big ones are Earned Income Tax Credit, Child Tax Credit, and its refundable pieces, and the American Opportunity Tax Credit. Add one more trigger: Head of Household Filing Status. On the EA exam, they love asking, which claims trigger Form 8867? If you see these, your due diligence radar should go off immediately. Why does the IRS care so much? Because these items drive refunds and the error rate is ugly. The IRS estimates about 1 in 4 claims for these credits is incorrect, which means billions in erroneous refunds. That's why the standards are stricter than they used to be. Exam tip: when you see refundable plus high error rate, think heightened preparer responsibilities and penalties. The IRS response is a set of 4 due diligence requirements. First, you must complete and file Form 8867 for each return with EITC, CTC, ACTC, ODC, AOTC, or head of household. Second, you must complete and keep the worksheets used to compute the credit. Third is the knowledge requirement. You can't ignore red flags. Fourth is record keeping. Keep the required documents in your files. That knowledge requirement is where preparers get burned. You don't have to audit your client, but you do have to be reasonably informed. If something doesn't make sense, like income that seems too low to support a household, or a child's residency story that keeps changing, you must ask questions and document the answers. On the EA exam, reason to know is the trap phrase. It means you can't play clueless. Also remember who's on the hook. The paid preparer can face penalties for failing due diligence, but the employer can be penalized too if an employee preparer doesn't comply. So firms build checklists, require documentation, and standardize interviews. For the exam, connect the dots. These rules exist because of high refund fraud and error rates, and the IRS uses penalties to force better screening and record keeping. What is IRC Section 6695? And why does it matter to tax preparers? One choice says it's about abusive tax shelters. Another says it's about improper disclosure or use of taxpayer information. Another says it covers penalties preparers may face connected to preparing returns for other people. And one option says it's about continuing education requirements. Think about it. The correct answer is that IRC Section 6695 outlines penalties tax return preparers may face in connection with preparing returns for others. It's a penalty framework for preparer failures, like not signing, not providing an ID number, or not keeping required copies and lists. The tempting wrong answer is the disclosure and use of information one, because that's a real preparer issue, but it's addressed under different rules, not 6695. Dante was audited, and the IRS determined he claimed the Earned Income Tax Credit incorrectly due to reckless disregard of the EITC rules. How long is Dante prohibited from claiming the EITC, even if he would otherwise qualify in future years? The options include 1 year, 2 years, 5 years, and 10 years. Think about it. The answer is 2 years. Reckless or intentional disregard of the EITC rules triggers a 2-year ban on claiming EITC in later years. 10 years is the tempting distractor because there is a 10-year ban, but that's for fraud. On the EA exam, watch the wording. Reckless disregard points to 2 years. Fraudulent claim points to 10.